imagine that you just retired and you have a pile of money and you want to get a great return. So, what do you do with it? Today, we're going to be inside the mind of a private money lender, and we want to know what kind of returns do you make with private money lending. So, let's get started. Inside the mind of a private money lender. So today we have John Damas. He happens to be a retired orthodontist. So, John, welcome.
Thank you. I'm glad to be here.
So let's kind of talk about the journey of medical field.
Yes.
And then you've been investing for a long time.
Quite a while.
Right? When did that start?
Actually, it started when I started my practice. Truth be told, it started when I was a teenager and I had a paper route. And I collected the people's fees for their papers and put that in a bank account and watched that grow. So that instilled an investing type of mindset. And then my investment started mostly when I started my practice.
That mindset, did that come from your parents? Where did that come from?
Absolutely. That's where it started with my parents. My father was a blue collar, a tradesman, and we lived a conservative life, nothing extravagant, but we saved for things that we wanted to do.
Okay, so that was kind of like a culture or the household. That's how you grew up.
Yes, it was.
Now, most people, you get into medicine, right? Generally, you start doing well. I mean, most orthodontists at some point in their life start making good money compared to the average person,
Yes.
Right? Did you ever go through a phase as a Yahoo? I'm going to have a great time, right? Because you're very passionate about living life.
I am indeed. I have a lot of expensive hobbies, unfortunately. I chose scuba diving and skiing. Other than golf, I don't think you could have more expensive hobbies, but so be it.
Right.
When I started my practice, I started a retirement account, an IRA account, at the same time I started my practice, because I knew if I saved just a little bit, but did it consistently every year, it would grow to a large amount.
Okay. And was that something, you've been married to the same spouse?
Yes.
Right. And I say that in that manner because we obviously live in a country with 50-some percent of divorce, because that takes a toll on one's financial life.
It does.
Right?
Huge
Going
toll.
through a bunch of divorces, I mean, that can have a terrible effect.
Yes.
Right. So was that, like, as a family, was that something you guys cleared up front, that both of us, because it can be one person likes to save, another person is not that way, right? Was that a common thing that you guys decided at some point early on that we're going to invest as a family?
We had a similar mindset.
Okay.
So my wife was on board with that because she could see that with us saving a little bit every year, she was also reaping the benefits of that also. So we were seeing eye to eye on that.
Okay, got it. And that's important because when two people are diametrically opposites, I mean, a lot of divorces, I mean, money is one of the big causes of a lot of divorces, how people choose to earn it and how people choose to spend it.
Sure.
Right? And early on, were you looking at it from a standpoint of, okay, by this age, I want to accumulate, maybe put aside X amount of dollars a year, and I'll end up with X amount? I mean, did you kind of do some of that financial homework up front?
Not so much homework. It was a goal of mine when I started my practice that I would retire at age 55.
Okay.
That didn't happen.
Okay.
I worked till 73 years old because I saw how the IRA was growing, and I saw the things that allowed us to do as far as our family, giving our family more opportunity, giving other people more opportunity through charities, helping others. It's kind of nice when you can do that and not have to worry so much about your own finances.
Got it. And so, but it starts with kind of being financially prudent to begin with.
Oh, absolutely.
Got it. So when you look back, right, for the last, I mean, you've kind of been investing for the last 30, 40 years, obviously.
Yes.
Right. Did you have you gone back and looked at, okay, what is my yield curve before you came into real estate as a private money lender, right? Which you started that fairly recently,
Yes.
right? Did you look at kind of your yield curve as to what you were getting in the markets when you're investing?
Early on, and through a good portion of my active career as an orthodontist, my investments were all in equities, virtually 100% in the stock market. And there were good years and there were bad years. But I would say the average was probably in the 10 to 15% range, which is pretty much the average for the stock market. Since I have retired, we've gone to a more conservative portfolio. And the returns for the last 3-4 years or so are more in the 8 to 10% range.
Got it. And did you ever think about it from that, the formula they always say, right? The 4% rule.
Yes,
the distribution
absolutely.
rule, right?
Yes.
Which is that, and again, it depends what your lifestyle is
Right.
and how much you've put away, right?
Right.
I mean, that's going to be, I mean, today, if you want to pull out 120,000 or so, you need somewhere around 2.5 million, right?
Yes.
Put away. And 120,000 today is not a lot of money.
Not so
right?
much. Not so
When you
much.
really look at it but it's a good amount of money if you don't have a lot of outstanding debt.
Correct. As we aged, we made it a point to pay down our debt, pay off our mortgages, no loans on the cars. Well, if a nice car comes up with 0% financing, I do jump on that. But basically, no outstanding debt, and that has helped us quite a bit.
Right. So when you look at that, right, in the stock market, you're saying early on, somewhere between 10 to 15% yield curve.
Yes.
Right. And then as you've gone into retirement, more like 6 to 8, somewhere in that ballpark.
Yes,
right.
correct.
So when this whole real estate, your brother happens to be in mastery.
Yes.
Right. And then he's kind of looking around, he's looking at properties, blah, blah. Was there this hesitation? Because sometimes people will have that, and oh my God, now what the heck is my brother up to? Right? Did you go through that, or were you fairly open to another opportunity? Because sometimes when people have done well, they become kind of much more pigeonholed into where they are.
Andrew, you could almost say that I turned cheap, because I'm looking at this and I said, no, I was in my little cocoon. I didn't want to go out. I wanted to stay in there. But looking deeper into the mastery program, I see how the guidelines are set up, what you have done with that, and I see that is a prudent and reasonable route to take.
Right. So when you're looking at it, right, so let's kind of talk about how what the yield curve is that we suggest, right? What we always suggest is 2 points up front.
Yes.
Right. So basically, if you're lending out 200,000, you're going to get 4,000 up front, right?
Yes.
Which you deducted when you do the loan.
Right.
So that you've earned 2 points. And then every month, you're charging 1% a month.
Another 1%
for 6 months. And then either you do a renewal or they do a payoff. And when they do a renewal, they have to pay you again 2 points.
Yes.
And again, you're right. So for the yearly yield curve is somewhere around 16%.
Right.
Right.
Yes.
Initially, when you heard that number, was like, oh my God, that's a huge number. Was that reaction?
Too good to be true.
Too good to be true.
Too good to be true.
Right. And that's something, because a lot of times people don't understand that, right? That how does a commercial lender make money in real estate? Right. If you were giving somebody money for a flip, you would charge that pretty much the same thing if you were a big
absolutely.
commercial lender.
Right.
So then why not you as a private money lender?
I think the commercial lenders are much more regimented by federal regulations.
Sure.
And there are many more hoops to jump through for the borrower.
Right.
Being a borrower in a small group such as Mastery, where there's guidelines established and more interaction with the people themselves. I meet these people, I see them, I talk to them, I see their properties. No commercial lender is going to go out to your property and take a look at it.
Right.
I do that. I drive out to see someone's property. I talk to them, and to see if this is a viable option. And it's a bit easier
Right.
for the borrower to get a private money loan than it is commercial.
And I mean, and a lot of times people don't understand, even real estate investors, this space of private money lenders, right? I mean, if you think about, we think about big businesses, Steve Jobs and the Microsofts and whatever, right? If you really look back and peel the layers back, at some point they had quote unquote a private money lender. Either it was their uncle, their parents, their
Right.
neighbors, their other crazy people, or somebody who's well off in the community. They said, okay, yeah, this kid is a crazy idea, but he seems smart. And I'm going to go ahead and lend a little bit. Maybe it's at risk, but there were people who were quote unquote, you can call it investors. Most of them don't consider them investors. They were just people who decided to give
Sure.
a little bit of a private money loan.
Right.
And most businesses in America are kind of formed that way,
Absolutely.
right? So when you're looking at it, and you kind of brought up this point, which is that versus going to a commercial lender, right, that'll give somebody a fix and flip loan or a loan to buy a rental property, right? In Mastery, why do people come to people like you, right, for private money? What's the difference between the two?
As I said, there's less regulation with a private money loan in the Mastery program, much less paperwork involved, and it can be done quicker. Some of these properties that the people are acquiring are at auction or short notice, and a commercial loan just can't be done that fast.
Right. So it's basically, this can be done at a much quicker pace.
Much quicker.
Right.
Yes.
Number two, it's Miss Mary is an example of that. Early on, when I was buying 2 properties, 3 properties, and I remember her coming to me and she's like, I'll give you a private money loan. And I'm like, I don't even know you. She's like, no, but what you're doing and how conservatively you're buying properties is attractive. That's basically the basis
Yes.
that you're lending on, right?
Yes.
You're not doing crazy loans. So what is the process through which you go through? Somebody approaches you, right? And you're kind of lending within that Mastery cocoon,
Yes.
right?
They'll send me a packet of information. It will be a description of the property, such as an MLS listing, but it will describe the property, the address, and so forth. And they will give an estimate of the rehab cost involved on what we call the 1-pager, also a 3-pager, a more detailed estimate of the rehab cost and the value after the rehab.
Mhm.
And what they're going to do as far as disposition of the property. If they're going to keep it in their portfolio and rent it, what the approximate rent would be, or if they're going to flip it, what the approximate sale price would be.
Got it. So you're looking at both of those.
Both of those. And then I also look at the person and their stability, basically their ability to repay me,
Right.
Especially if there are any issues or concerns or problems with the rehab. I will loan a certain amount that they estimated for the rehab, but there perhaps might be another issue, a plumbing problem or something that they have to correct. That's going to be on them. So they have to have some skin in the game too,
Right.
and be able to do that.
So you've done both types of loans, right? You've done 100% lending, meaning purchase and the rehab.
Yes.
Completely.
Yes.
You're funded. So they didn't come out of actually pocket of anything except
No.
earnest money. They pick it up a couple thousand
Right.
bucks earnest money,
Right.
right? And then at the time of closing, you paid the 100% of the purchase price,
Yes.
as well as you gave them a little bit of funds to get the rehab started.
Correct.
And then they'll take distributions.
Yes.
On the other end, you've also done partial loans.
Yes.
So how do you decide that?
The partial loans that I have done were on properties that were a bit more expensive,
Okay.
bigger properties, and had a more extensive rehab involved. It was a big investment, and I did not want to be fully committed to fund that in 100%.
Right. So a couple of loans, like you're doing, let's just, I don't remember the amount. Let's just say 300,000 for purchase.
Yes.
Right. And then it's another 100,000 for rehab.
Yes.
Right. And my point to you was, I'm like, it's a good property,
Yes.
probably back end 550 or so.
Right.
But then how about maybe you give 350 total?
Yes.
Right. So you as a lender are in the driver's seat.
Yes.
right? So in case something goes wrong, your money's never at risk.
No, it's
Okay.
not.
So then we always want you to go through a process. Number one is you're going to vet the property to make
Yes.
sure it makes sense. Then do you take what Rahul says into consideration?
Oh, absolutely. I don't make a loan unless Rahul has approved the property and given a good review of it to make sure that everything is going to run smoothly or as smooth as possible.
Got it. And then what about as far as the paperwork? Because you need a mortgage, you need a note, you
Yes.
need what's going to happen with the funds, you need all that documentation. Are you generating all that documentation? Who does that for you?
That is one of the major assets and advantages of the mastery program. The mastery program is set up to generate all of those documents, and using the mastery attorneys, all of those documents are generated in a day.
Right.
They can be done in a day, whereas the commercial loans that we spoke
Sure.
about take 3 weeks, and
Right.
they're constantly coming back to you. Oh, we need one more item. We need one more item. With the mastery loans, everything is filled out and done in a day.
So not only is the property vetted, you're right.
Right.
Then Rahul is kind of double checking the numbers
Yes.
internally. Then you're making sure the borrower is
Also
somebody that
vetted.
can,
Yes.
that can obviously get the job done.
Right.
Right. And it's not, and you've done some of the loans to new people, right? So it's okay.
To me, they were all new.
Yeah. No, to you, they were all new. But I mean, people who have never done this before, right? It may be like, oh my God, this is my first loan.
About half of my loans are to people who are doing their first project.
Right.
But I meet them at the mastery meetings.
Sure.
I talk to them, and several of them are family affairs where
Sure.
it's either a father and a daughter, or a
Sure.
mother and daughter,
Sure.
or two brothers. And it's good to meet them in person, and I feel much more comfortable doing that.
Got it. So is there a social aspect of it also? Because just knowing you, right? In general, you seem like a very people person, right? Because with stocks, it's a very, hands off. Like,
It's cold.
okay,
It's cold.
it's cold. It's cold. But here, not only are you getting a bigger yield curve, but there is also a social aspect of it. I mean, it's kind of a part of a team. We're doing it together. They clearly benefit, and you benefit also.
Yes.
Does that play some sort of a element to it also?
It's a win-win-win. Both parties benefit, and you get to see them at the various mastery meetings.
Sure.
And get-togethers, and meet other people. They will introduce me to some of their friends, and I take that as a close referral. And this has really been a major aspect of the mastery program. After I retired, I had several projects around the house that have been waiting for me for 40 years. And I found that I got them finished in a few months' time, 6 months, 8 months, and I almost stopped doing anything. I didn't want to become a couch potato, and the mastery program has kept me just as active as I want and need to be.
Right. No, because and I think some of that also is that as people retire, right, it's not just about how much money you have. That's obviously an aspect of it. But then what do you do with your time?
Yes, exactly.
Right. I mean, for you, you mentioned you're passionate about scuba.
Yes.
And you go all over the world.
I do.
Right. Chasing that dream and skiing.
Yes.
Right. But then what else do you do with your time? Right. And this is a great way. I mean, you haven't bought any properties yourself.
I have not.
Okay. You could.
I could. And actually, I had 2 properties that I was looking at, which you looked at, and you pointed out some things that I was blind to. So fortunately, we passed on those properties.
And I'm going to talk a little bit about that you have to look at it as an investor profile. Like,
Yes.
your style of investing in the stock market is very different
Oh,
when
totally.
you're 25 years old
Yes.
versus when you're 69.
Yeah.
Right? Because it's, you may plan on living to 100, but when that toilet paper is going to run out is nobody knows.
Nobody
right?
knows.
Nobody's date
Nobody
is
knows.
written.
No.
We know there's a date for all of us. We
Yes.
just don't know when.
Yes.
Right? But then,
And whenever it occurs, it'll be premature.
Right, right, exactly, right. But I mean, your style of investing has to change, and so the investor profile, like when we sat down to the business planning meeting, like, listen, man, you've done well for yourself investing all these years. Now the question is, do you really want the headache, right? Because at the end of the day, owning real estate, there's some headache to it, clearly,
Yes. Yes.
right? So you could enjoy the same benefits, get a huge yield curve as a private money lender,
Yes.
right? And so
Exactly.
far, that's what
Exactly.
you've chosen to do.
I have chosen that, and it's worked out tremendously.
Right.
It's just what I was looking for, with the right amount of involvement, and a fantastic yield curve too.
Right. No, because a lot of people, what they don't realize is like, so a lot of people um, within at least mastery group that they're doing $1 million, $2 million, $3 million, $4 million, $5 million in lending, right? On $1 million, there's not very many places where you can make $160,000.
Not so much,
Right.
Not consistently
Consistent.
and reliably.
Right. And the beauty, but it has to be done safely. I mean, that's
Yes,
the
and
biggest
safely,
issue.
right.
Right. And the beauty of that is, especially if you're doing within your IRA, right? That money grows.
The magic of compound interest.
Right. That money grows, and it's a beautiful thing.
It is. It is.
Because that literally you can keep putting it away in your IRA, and then, I mean, some of it age-related distributions you have to take, but that's all you pay tax on.
That's all.
Right.
And my wife is already talking about bumping up that 4% withdrawal to maybe 5.5 or 6.
6% withdrawal. Right.
But it's fine.
Right. So, any thoughts that you want to share from your end for other people that may consider private money lending?
I think that this is a perfect vehicle for a person in my position. Not only in my position, but certainly for a person in my position, a retired person who has funds that are in the stock market and doing fairly well, up or down, but to change some of that to something that will generate a consistently higher return. This is a wonderful vehicle to do that.
Great. Having said that, for everybody that is listening, I mean, for private money lending is something that, number one, needs to be done safely, meaning, John said, vetted properties. You have to do it with people that you know are investing in a safe area.
Right.
Right. So it's not just like somebody where they're doing a syndication and you don't know where the money goes and how that money is being appropriated and used. And then what backs it, right? In your
Yes.
case, you have the first lien
Yes.
against the
Always.
property,
Always.
always. So that's the biggest issue when you're putting it in a syndication, because I'm sure over the years you've been offered, hey, invest with me in this real estate venture and so on and so forth, where it's a syndication.
Oh, quite often. Yes.
Quite often.
Yes.
Right. And you've stayed away from it mostly?
Yes, I have.
Okay. Because with a syndication, the problem becomes is they're pooling money, right? And so if that syndication doesn't work out, even the operator is not on the hook,
No.
right? Because it's like, well, oops, it didn't work out,
Yes.
right? And so because
The oil drilling venture was kind of like that.
Like that, right?
Oops, it didn't work out.
yeah.
Okay.
Okay, yeah. I mean, and there's nothing you can do as long as
No.
they haven't used the money for themselves,
No.
right? And the venture fails. Here, it's backed with real estate,
Yes.
right? And as long as you're doing prudent loans, it's underwritten well, it can be an extremely great place to invest. Having said that, John, thank you so much for being here. I think it's
My
gonna
pleasure,
be a
Andrew.
huge inspiration for people who are listening.
Thank you for having me.
because private money lending is not talked about as much. You're listening to Andrew Holmes with Cashflow for Life. Thank you. Please like, love, share, and that's how we get to grow. Again, thanks so much.
My pleasure.